and even some extras.
Yeah, anyway, you should be reminding me just like this.
Okay.
All right. So today we're going to look at risk assessment. So risk assessment is quite an interesting topic, given that it's frequently examined, if not always examined. It's like consolidation. All right. So for the most part, risk assessment
Okay.
is examined. So you have to know it very well. You have to understand it very well because a lot of questions, maybe 20 marks, can come from this topic. So you have to really, really comprehend it very well, right? So now, what is risk assessment? So basically, risk assessment, I'll give the analogy of the conversation that we had on Saturday last week, where when you're looking for your wife, there's these, steps and stages that you need to take so that you try to understand that person and her character, so that at least when you're taking her home, you're marrying her, so that you know exactly what you're getting into, huh? So it's like when
Yeah.
you're yeah, when you're testing out, you're taking out, you're asking her her view on different topics. It's like you're assessing the level of risk that you are getting into, so that you have an idea of the person that you're dealing with. You know, so this is what risk
Yes.
assessment is also about. It's the same thing. So we as auditors, we go in the business before we begin auditing. We go in the client's business. We have an understanding, we have a feel of their business, their controls, the rules and regulations that surround that particular industry that the client is in. We understand how so if it's a warehouse, right? We understand just how they carry out their business. So when we understand how they carry out their business, we can go back to the office, and then we plan of how we're going to approach that particular audit, given what we have assessed, given the risk, given the level of risk that we've been able to assess as auditors. So this is what risk assessment is all about. So now it's something that you need to understand. This is I don't think it's something that you can be asked, but it's just for knowledge is sake. So basically, when we're starting an audit engagement, the first thing that we need to do, we need to plan, right? We need to plan out the audit. After we plan out the audit, in that planning, there's also we create a strategy. So in the audit plan, we create the audit strategy. So the audit strategy is a broad scope or understanding of how we're going to approach the audit engagement, right? Then the plan is more detailed as opposed to the strategy. So now, after we plan and we create the strategy, we need to carry out the risk assessment. We go to the client's business. So at the head office first, if we're looking for PwC, we just sit at the head office, we brainstorm, we ask ourselves questions. Okay, which parts of the business can be susceptible to risk? So which part of the business can be can 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 be can be like prone or can be vulnerable to a lot of risk? Maybe you might say depreciation. Okay, so we need to focus more on depreciation. Then if we're dealing with a client which is maybe a trading company, it has got a lot of inventory, right? So we can say, okay, for this particular
Mhm.
audit, we need to focus more on inventory. So that's the risk assessment part. So now we can go to the client's business, we observe, we ask management different types of questions, we carry out analytical procedures. But the issue is we need to get an understanding of that particular client so that we can assess the level of risk that's associated with that particular client, right? So now when we assess the level of risk, how risky is this client? How are the controls? What are the rules and regulations which are surrounding this particular industry? And is our client likely to follow? And that way we can be able to create the strategy and how we're going to approach the audit. So now, if we discover that we've carried out our assessment and we discover that this client has got very concrete controls, we discover that they've got very effective and efficient systems of recording and just controls and control system. We're just going to carry out what we call a test for controls. So we just test the controls. Are the controls working? Okay, we know Zanaco has got a good system of controls, but are these controls working? So after we carry out that risk assessment, then our response to that risk that we assess, if we believe the client is very well organized and structured, it has got a strong system of controls, we just carry out the test for controls. But if we discover that while carrying out the risk assessment, we discover that they've got poor controls. The controls are very poor. We also discover that after testing for the controls, we discover that okay, maybe these controls are not reliable. We need to carry out a full substantive test, right? So if we discover that the client is very risky, right? It's very risky. We need to carry out a substantive testing, right? But also, when we're carrying out the test for controls and we discover that the client is very risky, we'll end up doing the substantive testing, right? So when we carry out these tests for controls and substantive testing,
Yeah.
depending on a particular scenario or the risk of the client, then afterwards we can be able to prepare the audit report. So this is just for you to have an understanding of the audit process. Are we together?
Okay. Yes.
Any questions so far?
No question.
Okay, so again, we're going to go back to the objective of the auditor in relation to risk, right? So the objective of the auditor is to obtain reasonable assurance or evidence on whether the financial statements are free from material misstatements relating to fraud or error, which allows the auditor to express an opinion that in all material respects, the financial statements are in line with the applicable financial reporting framework and reporting that opinion to the intended user. So when it comes to risks or risk of material misstatement, right, the auditor needs to obtain sufficient appropriate evidence, right, in relation to risks that financial statements may be misstated due to fraud or error. When we obtain that evidence, we need to use that evidence to create or to express an opinion that in no material respects financial statements have been what prepared in accordance with the applicable financial reporting framework. Also, this is just for understanding purposes. This is not the core of the topic. Okay, so now, when conducting an audit, right, the auditor must apply professional skepticism as well as professional judgment. Remember, in professional ethics, we looked at this, right? This is just somewhat
Yes.
a revision, right? So, an auditor must apply
Yeah.
professional skepticism and also professional judgment. What is professional skepticism? This includes a questioning mind, alertness to events or conditions which may result in material misstatements, as well as critical analysis of audit data, right? Now, what is professional judgment? Professional judgment is using the skills or training, knowledge, and experience when making decisions which are relevant for audit purposes. So these two factors are very, very important when we're carrying out an audit. So as an auditor, you need to have a questioning mind and you need to be alert to events or conditions which may result in material misstatements, right? Material misstatements, these are maybe errors or omissions which if the user analyzes those financial statements, it may affect their decision making, right? And when we're given data, you as an auditor, this is a data that you need to analyze. You need to critically analyze that particular data so that you can arrive at an appropriate uh, opinion. That's professional skepticism. Then professional judgment simply means we have been trained as auditors. We've got the knowledge in auditing. We've got the experience. So when we're making our decisions in relation to the misstatement or the errors or materiality, we need to make sure we apply our professional judgment to the best of our ability. In that way, we can be able to obtain sufficient appropriate evidence that's going to allow us to express an appropriate opinion. So now, Let's look at what is audit risk. So now this is quite important, right? Audit risk. So audit risk is a risk of an auditor expressing an
Yeah.
inappropriate opinion when the financial statements are materially misstated or there's a material misstatement, right? So us as auditors, our job is to go into the client's business, we obtain sufficient appropriate evidence, right? Then after we obtain that evidence, we need to express an opinion, right? But now, audit risk is a risk that we may express a wrong opinion. We've collected the data, but due to maybe applying the wrong procedures or due to the inherent limitations in the controls of the client's business, we express a wrong opinion. So maybe the business or the client's business is about to go bankrupt in the next 2 years, right? But us as an auditor, our job is to obtain evidence that's going to give assurance that that company is going to last in the next 10 years, 30 years, right? It's going to be a going concern. But when we carry out the audit, we express an opinion saying that company is going to last for the next 10 years, but in the next 2 years, it goes bankrupt, right? Then we have expressed an inappropriate opinion. All right, so that's audit risk. So audit risk, once more, is a risk that the auditor expresses an inappropriate opinion when the financial statements are materially misstated or there's a material misstatement. So audit risk is made up of three types of risks, right? There's inherent risk, control risk, as well as detection risk. So what is inherent risk? Inherent risk is a risk of material misstatement arising due to the nature or characteristic of a transaction, right? That's inherent risk. Inherent risk is a risk of material misstatement arising due to the nature or characteristic of a transaction, right? So let's give an example of depreciation. So when we're depreciating an asset, we use professional judgment, right? We just assume. These are just an assumption. Or depreciation is not really a real expense, right? So there might be a mistake that we might inflate the depreciation, like the depreciation is not what it's supposed to be, right? Or even an example of a provision, right? A provision is an estimate. It might be inflated, but in actual sense, the amount is not what we think it's supposed to be. So that risk, that the depreciation may be inflated, is what we call an inherent risk. So that risk of material misstatement arising due to the nature or characteristic of a transaction, right? Then control risk. So control risk is a risk of material misstatement which occur due to the inadequacy or inefficiency of the client's internal controls, right? The client's business, they've got very ineffective and inefficient controls. They don't have any system of keeping proper records, right? They don't have any proper system of double entry. They don't have any proper system of maybe they don't have any system relating to the payroll. Maybe when you go to the warehouse, there's no CCTV. The controls of the business, they are very poor. So when the controls of the business are very poor, us as auditors, when we go and reviews the financial statements, there might be um, there might be a risk that we might express a wrong opinion. Why? Because some information may not be captured by the inadequate system of controls that the client has, and that's the control risk. Then three, we've got the detection risk. We've got the detection risk. So detection risk is the risk that the auditor applies the wrong procedures, you know, such that they don't pick out the misstatement which may exist, right? So now detection risk is a risk that the auditor, when they go into the particular business, they apply wrong techniques, then such that they're unable to pick out the risk of material misstatement, or in other words, they're unable to pick out the errors or omissions, or indeed the material misstatements which may affect the financial statements, right? So now, detection risk is risk that can be controlled by the auditor, right? By one, carrying out an effective risk assessment, and two, carrying out the right procedures which respond to those particular risks that we establish, right? But inherent risk and control risk is not in the control of the auditor. The only risk that's in the control of the auditor is detection risk. Detection risk is in the control of the auditor, and the auditor needs to make sure they put in place the right techniques and procedures so that they may reduce detection risk to an appropriate level, such that they may express an opinion which is reliable, and they may give the shareholders and the other intended user the reasonable assurance, right? So now,
Yes.
what is a risk of material misstatement? So a risk of material misstatement is a risk that the financial statements contain material errors or fraud that could impact overall financial picture of a company, right? So a risk of my material misstatement is just, the possibility, the probability that the financial statements may contain errors or misstatements which may adversely impact the financial picture of the company. All right. Then here the last point is audit risk directly affects the financial statements. So in the questions that you're going to be coming across, you're going to be mostly given a scenario. Then in that scenario, you need to pick out the audit risks as well as the business risks, right? So you need to be able to differentiate between audit risks and the business risks. So audit risks, they relate directly to the financial statements, right? So in the scenario that you're going through, if, for example, it's talking about controls, you know, the client has a poor system of controls. The poor system of controls directly relates to the financial statements. Because, for instance, if in a warehouse, this is a practical example, in a warehouse, there's no CCTV, then we're keeping inventory, all right? It's easy that that inventory can be stolen. And when that inventory is stolen, it means that inventory, closing inventory in the financial statements has got the possibility of being misstated, all right? Then that's just an example of an audit risk. The other audit risk is where maybe the auditor is using auditors who are inexperienced. Maybe to reduce the costs to the firm, they use auditors who are inexperienced. So inexperienced auditors, they might apply the wrong techniques when they're carrying out their audit, and that's uh, an audit risk. So one thing you need to remember is audit risk directly affects the financial statements. And audit risk is made up of inherent risk as well as control risk as well as detection risk. So these are important points that you need to remember when you are going through a scenario and you're picking out the audit risks. Any questions so far?
Mm, no questions. But I think in the paper for last semester,
Mm-hmm.
is it a semester or last exam?
That's the exam session, yeah.
Yes, there was a question for a scenario where they were looking, I think, for things like this.
Yes. So now you need to be able to
Yeah.
pick out the audit risks. So, uh,
Yeah.
yeah. So after this lesson, you should go and try and attempt it.
Yes, I will.
Yeah. So again, I'll emphasize the key to finding the audit risks in the particular scenario is one, they affect the financial statements directly. So you need to see, is it relating to controls, right? Controls. If the controls, maybe if it's relating directly to the controls, that's an audit risk. Then if maybe it's dealing with estimations, and all these other factors that are related to the inherent risk, that's also uh, an audit risk. Then detection risk, where the auditors, they're applying inappropriate techniques when carrying out that particular audit. So now let's look at business risk, right? So what is business risk? Business risk is a risk of an organization not achieving its objectives. So that risk that an organization may fail to achieve its set targets and objectives is what we call a business risk. So business risk affects the organization as a whole, right? It indirectly affects the financial statements. So now, a business risk affects the organization as a whole, right? And the classes of business risk are: one, operational risk; two, financial risk; three, compliance risk. So operational risk resulting from inefficiencies in the organization's operations, right? So for example, poor management. So let's go back to the definition of audit risk as I give this example. So, audit risk is the risk of an organization failing to achieve its objectives. So, let's say we've set an objective of increasing sales by 20%, right? But now we've got an operation risk where we are unable um, to, okay, we have a poor system of managing inventory, right? Such that employees are stealing our inventory, right? Because you don't have any system that's securing that particular inventory. So employees keep on stealing inventory in large numbers, such that when customers come and buy, we don't have any supplies to give those particular customers, right? In that way, we'll be failing to meet our sales targets. Why? Because we don't have the inventory. Why don't we have the inventory? Because of our poor management. You get the concept?
Yes.
Yes. So now that's a business risk. So the business risk first affects the business as a whole, right? And then it affects the financial statements. So it begins by affecting the business as a whole. Then when it affects the business, that effect on the business is what now affects the financial statements, right? Then there's also financial
Yes.
risk. Financial risk is risk that the organization will not obtain further finance, right? Financial risk uh, can be related to gearing. So most of the times, financial risks are related to gearing. So a company has got a lot of debt, right? If a company is highly geared, it's got a lot of debt, then it's a financial risk. So when a company has a lot of debt, it's highly geared, you know, it means there's a chance, there's a possibility that it may fail to pay its debt obligations. And when a company fails to pay its debt obligations, the lenders are going to sue and are going to request liquidation. And when they request liquidation, that particular company will not be a going concern. Then it means we're going to have a going concern problem in that particular business, right? And that's an audit risk because it's affecting the organization. Oh, sorry, that's a business risk because it's affecting the organization as a whole. Then three, rather, we've got compliance risk. Compliance risk results from the breach of rules and regulations. For example, not providing safety equipment to the employees, right? So compliance risk results from breach of rules and regulations. So there are certain industries which have got a lot of prescribed rules and regulations that the company needs to follow, such that if a company doesn't follow those rules and regulations, right, we're going to get fined.
Mhm.
If we don't get fined, maybe our practicing license uh, is going to be taken away from us. Will no longer be operated. So if our practicing license is taken away from us, that company won't be a going concern, right? So, and that's a
Yeah.
compliance risk. So, but sometimes in the exam, there might be some uh, points which are relating to the industry as a whole. Maybe sometimes uh, the industry is very competitive. You know, those points like those. No, the industry is very competitive. So when you discover that no, the industry is very competitive, that's a business risk. Why? Because it's going to affect the company's profitability, and if a company's profitability is affected, it's going to affect the going concern of a particular entity. So that's a business risk, right? Maybe the industry is very volatile, you know, demand shifts more often than not. That's also a business risk. So business risk affects the business as the whole. The operations of a business are affected as a whole, but audit risk is directly affecting the financial statements. So this is a difference that you need to be very conversant with as you are tackling the questions in the exam. Any questions so
Okay.
far?
No questions.
Okay, additions or given the actual work experience that you had.
Yeah, so I can add. I think everything you've mentioned there, it's there. So for the business risk, I also, if
Mhm,
I can look at the loan business, the risk is there. Then concerning work, where I work, these operational risk
mhm,
resulting from inefficient in the organization operations, poor management. So at times you find that those checks when customer brings checks
mhm.
when they want to pay by check.
Yes.
So they are post dated checks and they are just normal checks. So you find that the operations manager maybe has not communicated to the cashiers that they shouldn't accept post dated checks.
Mhm,
And the cashiers will go ahead and accept those checks,
mhm,
which will take time to clear. And at times they are fake checks because now people can clone the checks,
mhm,
can make a check fake, like in material, they're able to make those things.
mhm,
So you find that that is a risk for the operation manager that needs to look out as he's doing his job.
oh yeah, yeah,
Yeah.
yeah. That's very
Also
true.
for also for compliance risk.
Mhm,
So as a business, we've got regulators. So we've got financial regulators, we've got the government, and we've got other institutions that regulate the business. So you find that if you are not compliant to some certain government authorities, we've got like tax authorities, those are regulators of the industry. We've got ZiCA. So you find that if you are not compliant to the rules that are set, you find that it's also a risk because you'll be receiving penalties, or the government to impose penalties on your company, and the company might close down, like what happened to Post
oh
newspaper.
yeah, yeah,
Yeah.
yeah. So now, as auditors, now that's our job now to understand the legal the rules and regulations that are surrounding a particular industry, and in that way we can be able to assess whether that company is complying or not, and if it's not complying, is the non-compliance material, is it going to affect the going concern of that particular entity? Thank you very much. I'm glad you are relating the information
Okay.
to what you already know. You can carry
Yeah.
on, huh?
Okay.
Okay. So now,
Yes.
let's now move to risk assessment. Right. So what is risk assessment? Risk assessment is a procedure carried out by the auditor which allows them to understand the entity and its business. right? Risk assessment attempts to understand the following. So let me go back again. Risk assessment is a procedure carried out by the auditor which allows him to understand the entity and its business. So when we're carrying out a risk assessment, we're just trying to understand the entity as well as its business environment, right? To help us plan our audit, how we're going to approach it. Are we going to test the controls, or are we going to carry out substantive testing? That's what risk assessment does. It helps us understand how we're going to approach a particular audit. So now, risk assessment attempts to understand the following. One, the client's nature of business. Okay. What is our client's business? What business are they doing? Are they a trading company? You know, are they a law firm? You know, are they maybe a mining company, right? So if we're able to understand the nature of the business, we can be able to understand the areas that we can concentrate on when we're carrying out the audit. That way, when we understand the particular business that the client is involved in, it's going to be easier for us to know how we're going to approach the particular audit, right? Then two, we need to understand the industry, the regulations, as well as the regulatory framework, right? We need to understand what rules and regulations are governing this particular industry that our client is operating in. So if we're auditing a bank,